Welcome back to Debit Credit Done, the podcast that makes accounting simple, practical, and totally passable. I'm your host, Dean Quartermaine, and this is episode 4 of our second series on the AAT Level 3 unit, Financial Accounting, Preparing Financial Statements. So last time out then, in episode 3, we tackled non-current assets, including acquisition, disposal, and part exchange, with full disposal account entries. Today then, we're going to look at depreciation, what it is, why it's used, and exactly how to calculate and post it. So firstly then, what is depreciation? So depreciation is the systematic allocation of the cost of a non-current asset over its useful life. So it's not about the asset's market value, it's about spreading the cost fairly over the periods that benefit from that asset's use. So for example, if you bought a delivery van for £20,000 and plan to use it for 5 years, you wouldn't charge the whole £20,000 to the statement of profit or loss in year 1. You would instead spread that over the 5 years. So why do we use depreciation? Why do we depreciate assets? Well, there's 3 key reasons. Reason number 1, the matching principle. What we want to do in our accounts is match the cost of using the asset to the revenue that asset generates. We want to hold our assets at a true and fair value and reflect a true and fair value on our statements. So we're going to ensure that the statement of financial position shows assets at their carrying amount, sometimes known as net book value, which is cost after depreciation. And then thirdly, the accruals basis. So recognising expenses in the period they're incurred, not when they're paid. Now, before we get too involved in depreciation, we need to understand this concept of residual value. So residual value is the estimated amount the business expects to receive from the asset at the end of its useful life. So after you finish using it and after any disposal cost. It's basically what you think you could sell the asset for at the end of its useful life. So if the residual value is £2,000, you wouldn't depreciate that part of the cost because you're not using up that value. So we'll come back to that concept of residual value when we start to look at some of the calculations a little bit later. So within AAT exams, certainly at level 3 and certainly on the FAPS unit, there's 2 main methods of depreciation that are examined. One is known as straight line, or straight line method, and the other one is known as reducing balance, or the reducing balance method. So if we start with the straight line method to start with, then the formula for the straight line method is annual depreciation is equal to cost minus residual value divided by useful life. Now, sometimes on AAT exams, the useful life is given to you in terms of number of years. So it might say 4 years. It might also say straight line 25%. So if it says straight line 25%, the formula changes slightly to cost minus residual value multiplied by whatever the straight line rate is. So an example then, the cost is £15,000, residual value is £3,000, and the useful life is 4 years. So we're going to do cost, 15,000, minus residual value, 3,000, comes to 12,000, divide by 4 years, which gives us £3,000 per year. Again, as I say, you in the question, it could give you a straight line percentage rather than a useful life. Just very similar, very similar calculation. The second way we can do depreciation is using this thing known as reducing balance. Now, reducing balance formula is a little bit different. It's depreciation minus the carrying amount multiplied by the reducing balance rate. Now, as you can see, this is slightly different because it's going to vary each year because it's based on the carrying amount. Now with straight line, it's based on cost minus residual value. So ultimately it's based on cost. Yeah. Reducing balance is based on net book value or carrying amount multiplied by the reducing balance rate. So as I mentioned earlier, the carrying amount means cost minus accumulated depreciation. So that's the cost minus all accumulation to date. And it's sometimes known as the net book value. So if we're using another example here, then we'll say the cost is £15,000. And the reducing balance rate is 25%. So in year one, this is really easy, because in year one, the carrying amount is the cost. So £15,000 divided by 20 times 25%, £3,750. That's easy. So that's the annual depreciation in year one. In year two, it becomes slightly more complicated because it's now based on the carrying amount. The carrying amount is £15,000, the cost, minus the accumulated depreciation to that point, which is the year one depreciation of £3,750. So that would give me £11,250 multiplied by a 25% reducing balance percentage, which gives me £2,812.50, which is clearly less than the first year's depreciation. Now, if you think about some assets lend themselves to reducing balance method. Now, there's two things with reducing balance method. You're never going to get to zero. Yeah, so this asset is always going to be worth something. It's always going to have a net book value. If you think about cars, cars, typically you lose most of your value in the early part of its life. And then as you get, once you've owned your car for 10 years, it doesn't really depreciate annually, doesn't really depreciate that much. Most of its value is lost in the first 3, 4, 5 years. So probably lends itself to reducing balance. Whereas some assets very much lend themselves to fixed amounts of depreciation annually. So straight line. Now, how do we post then depreciation into a set of accounts? So let's start with a straight line example. So a straight line example, got an asset, the equipment, a piece of equipment that costs £10,000. It's got residual value of £2,000 and a useful life of 4 years. So we're doing straight line. So straight line, cost minus residual value. So cost 10,000, residual value 2,000. That gives us 8,000. Divide that by 4. We've got £2,000 worth of annual depreciation. So we can post a journal entry for the depreciation. So we go into debit depreciation expense on a statement of profit or loss for £2,000. Now it's the depreciation expense, so it's a debit, £2,000. And then we're going to credit accumulated depreciation on a statement of financial position for £2,000. Now, people say to me, Dean, why is it a credit? Well, it's a credit because you're reducing the value of the asset that's sitting on the statement of financial position. So the asset, that was a debit, and you're reducing its value, so you're going to credit it. Although it's not to the asset account, it's to another account, so that we can see what the depreciation is. The overall impact is that reduces the carrying amount of the asset. The reducing balance example then, doing the similar thing. Equipment costs £10,000. We've got a rate of 25%. So in year one, we're going on carrying amounts. Carrying amount of the asset in year one is just its cost. £10,000 times 25%. So we got £2,500 of annual depreciation. So again, we're going to debit depreciation expense, statement of profit or loss, £2,500, and credit accumulated depreciation of the statement of financial position for £2,500. So that's how we account and recognise entries for depreciation. It's really no more difficult than that. Yeah, where it becomes difficult is this next bit. Yeah, where we talk about depreciation policies and these concepts of pro-rata calculations. So businesses quite often out in the real world, yeah, have rules like full year's depreciation in the year of purchase, none in the year of sale, or pro-rata depreciation based on the number of months you've owned the asset. So an example, a machine was purchased on the 1st of April for £12,000. Depreciated straight line over 5 years with no residual value. And the year end date is the 31st of December. So we can calculate to start with what the annual depreciation is. So the annual depreciation, we purchased it for £12,000. Yep. So £12,000, yeah, straight line over 5 years. So 12,000 divided by 5, £2,400. So that's the annual depreciation. Yeah. Now, because we only owned it from 1st of April to end of December, is it correct to charge a full year's depreciation? Quite possibly not. Quite possibly we just want the 9 months. We want to pro-rata the depreciation for 9 months, the period of time we owned the asset. So we can just do 2,400 times 9 over 12. Yeah, so 9/12, yeah, or 3/4, yeah, of £2,400 is £1,800, which is the real true amount of depreciation we should be recognising, yeah, in the statement of profit or loss and in the statement of financial position. So we would then post our depreciation journal. Debit depreciation expense £1,800. Credit accumulated depreciation £1,800. So what we're going to try and do now then is bring all of this together in one complete comprehensive works example. Yep. So a business buys a delivery truck for £18,000 on the 1st of July 20x1. At that point, we've got a residual value of £3,000 and a useful life of 5 years. And the depreciation policy is straight line and pro-rated in the year of purchase. So the first thing we need to do is work out what the annual depreciation looks like. Yeah, so annual depreciation, cost minus residual value, divided by useful life. So £18,000 cost, £3,000 residual value, useful life 5 years. So we've got £3,000 per year of annual depreciation. Then the question tells us pro-rated in the year of purchase. So in the year of purchase, we purchased it in 1st of July. So we've only got 6 months, July to December, 6 months worth of, 6 months ownership of the asset. So we only want 6 months worth of depreciation in that first year. So we can take 3,000 and multiply it by 6 over 12, yeah, or 1 over 2, half, yeah. So half of 3,000 is £1,500. So we then post the journal entry for the first year. So debit depreciation expense £1,500, credit accumulated depreciation £1,500. That's the first year's depreciation done. Second year's depreciation, yeah, a full year's 3,000, yeah. Full year's depreciation 3,000. So all we're going to do is literally post a full year's depreciation. Yeah. So debit depreciation expense 3,000, credit accumulated depreciation £3,000. And then the carrying amount, if we wanted to know what the carrying amount of the asset is at the end of year 2, it's the cost, 18,000, minus accumulated depreciation. Yeah, which would be the £1,500 from year 1, the £3,000 from year 2. So we've got an asset with a net book value or a carrying amount of £13,500 at the end of year 2. Now, there's a couple of things I just want to talk about before we get into sort of a wrap up of today's session around exam tips. So some tips and tricks that I've built up and come across over the years that help with depreciation. Lots of students don't do this, but you can choose to do it or not. But in the AAT exams, you've got a little highlighter tool. Now, what I say is that is really, really useful. So what I do, or what I would suggest you do, is to highlight the depreciation policy within the question, because that quite often impacts what you do when you're answering the question, and whether you apply pro-rata rules or a full year's depreciation, either in the year of acquisition or the year of disposal. Watch out for residual values. Now, we all know that AAT like to hide information within the questions. Yeah, so some questions hide this residual value within a whole bunch of text about lots of things. Yeah, watch out for residual value, because obviously that impacts, certainly if you're doing straight line. Yeah, well, you're only going to have residual value with straight line anyway. Yeah, it impacts that calculation of depreciation. Now, if it's a reducing balance calculation, remember to use the carrying amount, not the cost. Yeah, lots of students just base it on cost and forget that actually should be on carrying amount. And if assets are bought or sold mid-year, check if the business policy is full year, half year, or pro rata. Just check what that depreciation policy looks like to ensure you get the correct calculation. Now, just a quick recap then of today's session, of today's podcast. So we've covered quite a lot today, but it's all around depreciation. So we've covered what depreciation is, why it's used, what residual value means. We've covered the straight line and reducing balance methods of depreciation, how to calculate depreciation on cost or carrying amount, depending on whether you're doing straight line or reducing balance. We've looked at pro-rata depreciation rules. So how do you calculate, once you calculate annual depreciation, how can you pro-rata that for actual ownership or actual usage? We've looked at what the journal entries look like for depreciation, which are quite simple. Debit, depreciation expense, statement of profit or loss. Credit, accumulated depreciation, statement of financial position. Gone through a full worked example, and I would recommend people, rewatch the podcast, rewatch the videos on YouTube, pause it, go back, make some notes, go back through it, rewind it, go through it as many times as you need to make sense of it. And then I've covered some exam tips that hopefully will help you pick up those easy marks in the exam. So the challenge before Monday's podcast session then, which will be episode 5, is this. So a business buys machinery for £25,000 on the 1st of October. That machinery has a residual value of £5,000 and a useful life of 5 years. Now, the company's depreciation policy is straight line, pro rata in the year of purchase, and the year end date is the 31st of December. What I'd like you to do then is calculate the annual depreciation, calculate the year 1 depreciation, and post the journal entry. And then I'm going to, right at the beginning of episode 5, I'm going to walk through the answer to that little challenge. So that's it then for episode 4 of Debit Credit Done. We've taken the mystery out of depreciation, from residual value to carrying amounts, so that you're both ready for the AAT exam and the real world. In episode 5 then, we're going to move on to this concept of adjustments. So we're going to look at accruals, prepayments, and irrecoverable debts, which will all help make sure that your financial statements reflect the true position. Until then, keep practicing, keep reflecting, and remember, debit credit done.